Welcome to Money Talks. This week we're going to discuss mortgages, what they are, what to look out for, how to negotiate with the banks, and what to do in the current economic climate. Mortgage lenders and many brokers speak a different language from the ordinary person in the street, and I'm going to bring this subject onto a personal level so that it will be meaningful to you. First of all, what is a mortgage? A mortgage is a long-term loan that's secured against a property. It's a huge financial decision, usually involving many thousands, if not millions of dollars, and you're generally committed to repaying it over a period of at least 20 years. It's probably one of the biggest financial transactions you'll ever make, so it's important to take your time, get the right information, weigh up all the options, and choose very carefully. The first three things that you need to take some time calculating are how much you can afford to borrow, what size of mortgage you can get, and how long your mortgage will last. It might be very tempting to borrow as much as possible, especially if you found your dream home, but it's important not to borrow any more than you can afford. Make sure you save some money for extra costs that you may face in the future. For example, rising property taxes, higher interest rates, if you're sick or laid off, increased utility bills, the list goes on. The average mortgage term is 20 years, but you can get a mortgage for any term from 5 to 40 years. Remember, however, that with a shorter term, you'll have higher monthly repayments. But because you're repaying the mortgage over a shorter time, you're going to pay less interest in total. With a longer term, you'll have lower monthly payments, but you will pay more interest in total. So I'm often asked, how long should I take out my mortgage for? I generally respond that the least possible term you can afford is the best, as you'll pay much less interest to your bank. In fact, if you find that you have extra money at the moment because your interest rate has come down, take this opportunity to pay more than your monthly payment, and you'll reduce your debt more quickly. This means that if you've been used to paying, say, $1,000 a month, and interest rates have dropped and your mortgage is now $900 a month, why not keep on paying the $1,000 a month, and you'll be reducing your outstanding debt painlessly. There are several different types of mortgage rate, but basically they fall into two main categories: variable rate and fixed rate. The variable rate, let's start with this. This can change frequently, as the central banks in most countries decide on interest rates every month. The interest rates in the US economy are currently at 0%. But don't get too excited, because that 0% doesn't apply to you. You'll probably be paying around 5% or more for your mortgage. So let's say your interest rate is 5% and your mortgage payment is $1,000 a month. And the bank reduces the interest to 4.5%. This could bring your mortgage payment down to $950 a month. So now you're thinking to yourself, my mortgage payment will be $950. So I'll be saving $50 a month. But don't spend that whole $50 until you see whether or not the bank is going to pass the full rate cut on to you. They may only give you $25 of that $50 back and keep the rest for themselves. So the advantages of the variable rate: if the interest rates fall, and your repayments may also fall. But given the fact that most countries right now are on very low interest rates, it's most likely they're going to go up from here. For example, as I said, the US is on 0%, the UK is on 0.5%, Europe 1%, Sweden minus 0.25%, Japan 0.1%, and New Zealand on 2.5%, with China currently one of the highest at 5.25%. Another advantage with the variable rate is that you can usually increase your repayments and pay occasional lump sums, thus saving you interest. However, this usually needs to be set up at the outset of your mortgage. So if you'd like the flexibility of being able to pay off larger sums of money, remember to ask your bank to put this into the terms of your mortgage at the beginning. The disadvantage with the variable rate is that if interest rates go up, your repayments will also rise. Now let's move on to the fixed rate. This is where your interest rate stays the same, no matter what the central banks decide each month. It can be fixed for 5 years, 10 years, or even the life of the loan. The advantage is that if interest rates rise, your repayments will not increase because they're fixed. The disadvantages are that you'll usually have to pay a fee if you switch to a variable rate, remortgage or pay off your mortgage early. but you cannot usually pay lump sums or extra amounts during the fixed rate period unless you've set this up in advance with your lender. Finally, your repayments will not fall if interest rates do fall. With the variable rate, your monthly payments can keep on going up month after month. And more likely than not, if you went into your purchase with a limited income, you could find yourself in the position of not being able to afford those payments. In which case, there's a likelihood of your property being repossessed. For the average person who either doesn't understand mortgages very well, or who doesn't have the time or the patience to keep track of mortgage rates, taking a mortgage at a fixed rate may be the best avenue for you, especially now as so many countries have very low interest rates. So to summarise, this is a huge financial decision. Take your time and do lots of research. Make sure you can afford the mortgage even if your costs go up substantially. Examine the pros and cons of the fixed rate versus the variable rate. And if you'd like more certainty, opt for a fixed rate. Don't go away. I'll be right back.